Good afternoon, everyone. I think Jeff might have done one or two of these, so difficult act to follow. So I'm taking you into lunch, so I'll try to hold you, so no sneaking out early for sandwiches either, so I'll keep it interesting for you. So yes, I'm here to talk about the Qualitas Real Estate Income Fund. It is relatively new. It is about creating a listed vehicle that invests in real estate loans to provide stable income. So really quickly on this, it's really, we're looking to raise between $150 million and $500 million. We're investing $10 million of our own money from our balance sheet. We're looking to pay an 8% per annum distribution payable monthly. It is a listed investment trust, so we actually don't have the issue of the franking credits that Jeff raised, so because we pass through all the income that the trust earns. And the offer costs are going to be fully paid by the manager, being Qualitas. We've recently lodged the PDS with ASIC, and we expect the general offer to open around the 16th of October. So the PDS is on the Qualitas website, so it's available to read. So firstly, just talking about Qualitas a little bit, we're a quite experienced and disciplined manager of real estate. We have been operating for 10 years out of Sydney and Melbourne offices. We do transactions more broadly than that, but we tend to do most of our transactions in Sydney and Melbourne. We do invest in real estate through joint ventures, and we also provide loans into real estate, which is much of what this trust is about loans as opposed to equity investments. We do have a very strong institutional framework in our organisation. We do manage money on behalf of institutions and high net worth individuals at the moment, and have been doing so for a long time. So we have fairly strong institutional framework internally and strong corporate governance. But a very strong board. I'll talk to our board in a minute really quickly. And we've got a strong track record over our 10 years. In fact, we've earned a 25% IRR on our debt transactions over that 10-year period. I'll talk a little bit about that as well. That is higher than you expect, and there's some reasons for that, but it is a strong track record nevertheless. We think investing in real estate loans is a compelling investment. You do have security over the underlying real estate asset. You have a real property security. It is an established institutional asset class, less so in Australia, but more so in Europe and North America, and I'll talk to that really quickly as well. Has an income stream, so you're lending into transactions that have rental agreements in place. So you're providing a loan to an individual to purchase a property that has an income stream. So you're actually capturing and have a contractual agreement with that borrower to pay the interest under that loan. And we're also very careful on capital preservation. So the loans that we make all have equity contributed by the borrower, so there's a natural buffer that you have there that sits in front of you or behind you, whichever way you look at it, in terms of taking the first loss position. So if you're lending somebody $30 million to buy a $50 million property, then they've put in $20 million of equity that stands to be the first loss. So that $20 million has to disappear before you're at risk of threatening a loan. As I said, we're looking to generate 8% per annum payable monthly. A little bit more about us. So we, as I said, we've been operating for 10 years. We've done so far 108 transactions over that time. Now, we could have probably done 108 transactions per year, but we're very disciplined about what we take on. So we have a strong filtering process to make sure that any loans that we take on are the ones we want to take on, and the clients that we lend to are the clients that we want to have in our organisation as well as partners to us. So very important that we hold our reputation. We have 70 people in our organisation across Sydney and Melbourne offices. Of that 70, 20 of us are the investment management team that are responsible for generating and originating transactions, for executing in those, and for managing those transactions. We have about $2 billion of assets under management at the moment, or funds under management at the moment, and that's roughly 2/3 institutional, particularly out of Europe and Asia, and 1/3 is from high net worth individuals. And you can see at the bottom of that table there our growth of funds under management over time. The kick up in the last 3 to 4 years is really about us expanding our debt offering to do a lot of senior debt, so first mortgage lending. Prior to that, in the early years, we really concentrated on equity investments and mezzanine investments, and it became apparent to us by doing that we could expand our offering to do senior debt. So that's why we had a kick up in the funds under management over the last few years. Very strong management team. Andrew Schwartz is one of the founders of the organisation, has been in lending and real estate investment for 30 plus years. Myself, similar. The other one I'll point out is probably Gerd Mayer, who's our Chief Risk Officer, long-term banker in risk roles. So we do have a very strong team in terms of experience across working with many banks and fund managers, particularly in real estate. Myself have been probably 24 years in real estate lending, in addition to some corporate finance. So we've got a strong management team. In terms of our board, won't go through each member of our board, but a very strong board that expands across accounting, law, private equity, funds management, superannuation and financial services. Some of our board members represent a few prominent boards, including the Reserve Bank. Carol's on the Reserve Bank of Australia board. She's on Stockland's board. Alana's on Mirvac's board. David was senior counsel at National Australia Bank and Telstra. So we've got a good mix, we think. Alana's probably our last board member to join, which I think was in 2013, so quite a stable board as well. The owners of the business are Andrew Schwartz to 50%. The other 50% is owned by Alan and Carol Schwartz. They're married. They're not related to Andrew, just a quirky coincidence of surnames. So this is an important slide. This is the opportunity. This is why we think this is really important at the moment in the market. So firstly, as I said, we provide loans into the commercial real estate market. That market in Australia is roughly about $280 billion. That excludes home loans just that banks provide. So outside of home loans, commercial real estate market is $280 billion. We think the banks control about 80% of that, so very dominant. So when you look to other markets around the world, Europe and North America, generally the banks probably sit somewhere between, it's very hard to get numbers, but somewhere between 40 and 60% is provided by traditional banks, with the rest of it provided by private lenders. So Australia seems really quite heavily skewed between the banks dominating that market. So firstly, that's the global opportunity. That sort of grows by 3% per annum. Now, we think at the moment that market share is eroding away from the banks. And it's not so much we think, we actually know through our transaction trading that that's happening. And there's a few reasons for that. The first reason is around that the banks are under heavy regulation through APRA at the moment, so the regulation authority around their exposure to real estate, the general risk appetite of what the banks are doing. So they're under regulatory pressure to just pull back a little bit, not be too exposed to the real estate markets. Secondly, there's the Basel Accord, which really monitors the capital position of the banks globally. So banks more and more are having to hold more capital on their balance sheets to support their lending and lending activities in real estate, but other lending activities as well. So they have to provide more capital behind their loans, and that means it's more expensive for them. And the other thing which you're all aware of is the Royal Commission going on at the moment, right? So there's quite a lot of activity. The banks and the superannuation industry, etc., all been thoroughly looked at by the Royal Commission. So I think that's tended to make the banks a little bit inwardly focused, more so than be externally focused. So all of that has caused the banks in the current market to be a little bit circumspect and pull back from the market. And the opportunity that exists now is for non-bank lenders like Qualitas to actually capture some of that market share. Remembering, if they give up 1% of market share, that's nearly $3 billion of transactions. And we think they're going to give up quite a lot over the next few years. I don't know what that is. It could be 5%, it could be 10%, but very significant and quite profound. And you're seeing what's happening at the moment is quite a structural shift and change in the market in terms of the participation of non-bank lenders into the market that's traditionally been dominated by the banks. And behind that, we think fundamentally the market's still okay. Yes, the residential market, as an example, is having a breather at the moment and resetting itself. Now, that's fine. We're quite happy with that position. You don't want the market to scream ahead and fall off a cliff. So having these little times in a cycle where the market moves up and then checks back a little bit, rebalances, resets itself, readjusts, we're fine with that. So Sydney audience, so you'll know that Sydney's having a breather in residential. You'll know that's slowed down a little bit. We're not supplying as many homes at the moment, and that's fine. I think that's an important adjustment. But don't forget that Australia, we have a population growth of around 400,000 a year. Melbourne, maybe 120, 130,000 new residents per year through migration and through natural birth rates. Sydney, around 100,000 people per year. So we're growing our cities. And if you look at Sydney and Melbourne combined, over the last 5 years, it's sort of grown between around about $1.1 million. So we've actually created a new Adelaide over the last 5 years between Sydney and Melbourne. That puts it in, if you visualise that, it's quite significant. So you've got to build houses for people. So the average household formation is 2.5 people per house. So if you're adding 100,000 people, you'll understand that you need to build quite a lot of new homes. And the mathematics is 40,000. You probably don't need to build that many, but certainly, it's 25, 30,000 new dwellings a year. So we still think that underlying demand for real estate is there, despite the market having a check at the moment. The unemployment rate's relatively low. The economy's going okay. You know that. So we think generally things are okay. So, but notwithstanding that, you've got to be mindful of the macro issues when you're making investment decisions. So we think the market's relatively capital constrained. We still see borrowers needing capital to invest in the real estate, to develop real estate, etc. So that's our thesis of why we think this is a good opportunity to put onto the stock market. What the types of loans we do, probably 3 categories. Firstly, we do investment loans. Investment loan is really just lending money to a borrower to buy a stabilised asset. A stabilised asset is an industrial property, an office building, a retail property. Might be 20 residential units that a developer decides not to sell, for instance. So it's really passive assets where there's an income stream, and you assess that loan because of the ability of the tenant to pay income. So pretty conservative type deals, like the example of industrial property earlier, 50 million acquisition, you lend that owner $30 million. We also do construction loans. We have done a lot of construction loans over 10 years. So that's really lending somebody money to develop a tower of residential units. And you'll know cities like Sydney and Melbourne are densifying. That is people living closer to cities. They're closer to the jobs, closer to amenity. And Sydney, for example, is a good example where we're a bit landlocked. We've got growth corridors in the northwest and southwest. But other than that, we don't have a lot of land. So you're really building vertically rather than horizontally, particularly in a city. So we do need to keep producing residential properties. So generally when we do construction, it's related to residential. And we like that because you have a clear exit or repayment strategy. You know where your repayment's coming from, and that is through the successful completion of that building and the ultimate sale of the units at the end that have been pre-purchased as you build along the way through. So we quite like residential for that nature. And also land loans. We do a few land loans, and that's really where a developer's bought a site, inner city site, we call it an infill site, so it's surrounded by residential, and they're getting that site ready for development. That is, they're tendering out the building works, they're selling the units, and within that 12-month period, generally, they're going to start the activation of that site for development. And that's a separate transaction for us, but the initial transaction is really helping them buy that site. I said earlier we'd earned 25% IRR on our money over the last 10 years in our debt lending activities. That's very true. We did have some opportunistic outcomes where clients paid back early and we had minimum earn periods, etc. And that sort of probably opportunistically elevated our returns a little bit. So that 25 is a little bit artificial. But notwithstanding that, those numbers on the right-hand side are what we're earning today on our transactions in terms of interest rates. So we're going to construct a portfolio that is balanced across asset type, geography to deliver that 8% return. And we think, given what we've been able to achieve in our life so far of 10 years, that we should be comfortably able to achieve the 8% that we're expecting to make for the LIT. So the top part of that graph is equity. We do that at Qualitas, but it's not for this listed investment trust. We do a lot of joint ventures and we understand equity, but it's not for this. What we're concentrating on is the senior debt and mezzanine debt, but particularly senior debt in the trust. And that's where you've got security over the property, you've got guarantees from the borrowers personally, you've got other security mechanisms, and you have that nice buffer, equity buffer that protects you. And really quick, I'll give you an example. if a developer's building a tower of units, it may cost them $100 million for that. Okay, they'll borrow, let's say they borrow $60 million. That means they've got to put in $40 million of their own money. They will make 20% on that, so it's actually worth 120 at the end. So they've actually got at risk on that transaction $40 million of cash they've put in, plus the 20 mil of profit. So that building actually has to half in value for the loan to be at risk. Okay, so very significant and deep equity and profit buffer that protects that loan position, right? So all loans are not exactly that. Some are a little bit higher, some are a bit lower, but what I'm trying to demonstrate is you've got that, when you're providing a loan, you've got that equity buffer. It's very different to an equity investment where you're sitting at that top end, where you're actually co-investing that $40 million with that borrower. This is below that. You've got that buffer in front of you. So we quite like that about real estate lending. As I said, we've got strong structural features. We do selectively some mezzanine loans. A mezzanine loan, really quickly, is a second ranking position. Okay, so in that example I gave you, that developer may come to us and say, I don't want to put $40 million into that transaction. I only want to put 30. Would you put $10 million in with me? And we may decide that we will do that $10 million, and let's say ANZ provided that $60 million loan, we may put that $10 million in as a subordinate piece and get a second mortgage for that. We get exactly the same security as the first mortgage, except it's second ranking. And because it's second ranking, it's higher risk, and we will earn 14 to 17% on that. So much higher yield. Yes, it's higher risk, but still got strong equity protections, because don't forget, you've still got $30 million of cash the developers put in plus the profit. So just on really our due diligence. So I suppose all we do is think about risk every day. So we look at hundreds and hundreds of deals across any one year. We're very careful on what we take on. We say no a lot more than we say yes. Our philosophy is really to do deals with people that we've done deals with before. So we don't want to just do one-off deals with a whole bunch of different people. We prefer to keep our client base limited and do multiple deals and build those relationships strongly. When we take a deal on in our investment team, we then parallel that process with our risk group. So not only are we doing the due diligence on the transaction, we bring our risk group in, and they're a different department, if you like. There's a proper demarcation line between my team and the risk team, and they mirror that transaction as we're going through. So ultimately, we get to the end of the process, we've produced a 50, 60-page document, which we then take to our investment committee for an approval. So very rigorous study on risk. The client is really important to us. The client is the one ultimately responsible for repaying the loan. So we spend a lot of time on the client, their capability, their experience, their financial backing, what have they done before, their reputation, have they worked through real estate cycles, all those sorts of things. Until we're happy on that, we won't proceed. Once we're happy on that, then we look at the underlying transaction and study that asset and see how that asset's going to perform in that investment period. And most of our loans are roughly 2 years, and it would be unusual for us to do a loan greater than 2 years. So we're not taking 10-year positions in a cycle, we're taking short-term positions. So once we look at the asset, then we want to understand why that asset's going to work. So if a client's developing a block of units in Bondi Junction, for instance, we'd probably like that because it's near transport, it's near shopping centre, it's close to the city. We look at the supply and demand in that precinct to make sure there's no other competing developments that could hamper our development, those sorts of things. So a lot of it's about the asset, but critically over the top of all that, unless we're dealing with the right person, then we're starting off on the wrong foot. So that's a really important risk element for us. Just on the portfolio, as I said, the majority of it's going to be senior debt. We don't think we'll need to put many mezzanine transactions in there. We're getting very good returns in the market on senior debt, and it's because of the banks pulling back. And a bank may provide a loan to a customer of 55% loan to value ratio. We may provide a loan to that same client at 65, for instance, provide a bit more leverage, if you like, or a bit more to that. But we can charge a premium for that. We're sort of getting, the bank may be at 5% on that, we may charge 8% for that loan. So at the moment, we're getting disproportionate pricing on our transactions relative to the banks because of the situation in the market at the moment. So dominated by senior debt, and this fund will actually invest in our current funds. So we have current funds that do all of this. We've been doing this, and this fund will invest in those funds, and also it will invest directly in some transactions as well. So Any fees that are earned in the existing funds get rebated back, so there's no double counting of fees. It's very transparent. There's only one fee charged on that transaction as it flows through. And really briefly to wrap up, as I said, we've lodged the PDS with ASIC at the beginning of the week. We expect the offer to open to the public following that on the 16th of October, and with a listing date at the end of November the 27th is our current aim. Thank you.